Between 2012 and 2022, the Knight Frank Luxury Investment Index tracked the performance of rare whiskey against a basket of traditional and alternative assets. Rare whiskey returned 564% over that decade. Gold returned 45%, the S&P 500 returned approximately 250%. Fine wine returned 149%. Whiskey outperformed them all. Welcome back to Capital Above Convention. Today, we are covering one of the most surprising, most tangible, and most misunderstood alternative asset classes available to investors. Whiskey casks, not bottles, not collections. Casks, the physical barrels of maturing spirit, sitting in bonded warehouses across Scotland, Ireland, Japan, and Kentucky, quietly appreciating as the years pass and the liquid inside transforms into something increasingly rare and increasingly valuable. This is not a novelty investment. The whiskey cask market is estimated at over $70 billion globally. It attracts sophisticated investors from hedge funds, family offices, and high net worth individuals who understand that the fundamental economics of whiskey production create one of the most compelling supply and demand dynamics in any alternative asset class. Let us start with those economics. Whiskey takes time. Scotch whiskey must mature for a minimum of 3 years by law. Single malts aged 12, 18, 25 years command significant premiums over younger expressions. The oldest and rarest expressions, 30, 40, 50 years, trade at extraordinary prices. A single bottle of 60-year-old Macallan sold at auction in 2019 for $1.9 million. That is one bottle. But the economics of whiskey investment are not about bottles. They are about casks, the barrels in which the spirit matures. A cask of new make spirit, fresh whiskey that has just come off the still, can be purchased from a distillery for a fraction of what it will be worth after 10, 15, or 20 years of maturation. As the whiskey ages, several things happen simultaneously that drive its value higher. The first driver of whiskey cask value is the angel's share. This is the evaporation that occurs naturally as whiskey matures in the cask, typically between 1 and 2% of the volume per year in Scotland. Over 20 years, a cask may lose 30 to 40% of its volume to evaporation. This means the remaining liquid is genuinely scarcer than it was at the beginning of the investment, creating a physical scarcity that drives up the value of what remains. The second driver is flavour development. New make spirit is relatively neutral and harsh. As it matures in oak casks, it takes on colour, complexity, and character from the wood. The longer it matures, the more complex and distinctive the flavour profile becomes. This transformation from raw spirit to aged single malt with layers of vanilla, dried fruit, spice, and smoke is what creates the premium that premium whiskey commands. The third driver is distillery reputation. Not all whiskey appreciates equally. Casks from distilleries with strong reputations, Macallan, Springbank, Glenfarclas, Port Ellen, Brora, command significant premiums over casks from lesser-known producers. Closed distilleries, those that have permanently ceased production, are particularly prized because their casks represent genuinely finite supply. Port Ellen and Brora in Scotland, closed in the 1980s, produce some of the most sought-after whiskey on the planet precisely because no new spirit will ever come from those stills again. The fourth driver is the global demand surge. The whiskey market has been transformed over the past 2 decades by the emergence of serious collector and investor markets in Asia, particularly Japan, China, Taiwan, and Singapore, and in the Middle East. Buyers who were not in the market 15 years ago are now competing fiercely for the finest casks and bottles, driving prices to levels that would have seemed impossible a generation ago. Let us now address the risks, because whiskey cask investment is not without meaningful ones. The first risk is fraud and misrepresentation. The whiskey cask market has attracted its share of bad actors. There have been documented cases of investors being sold casks that did not exist, casks of inferior quality misrepresented as premium stock, and casks stored in unregulated facilities rather than the bonded warehouses required by law. Due diligence on the cellar, the storage facility, and the provenance of the cask is essential. Always insist on a warehouse receipt from a regulated bonded warehouse. Always use a reputable broker with verifiable track record. The second risk is liquidity. The cask market is less liquid than the bottle market. Finding a buyer for a specific cask at the price you want, when you want, requires patience and the right connections. The maturation process also ties up your capital for the duration of the holding period, typically 5 to 15 years for a meaningful return. This is genuinely patient capital. The third risk is quality variability. Not every cask matures as expected. The interaction between spirit and wood is unpredictable. A cask that was expected to produce exceptional whiskey after 15 years may have developed poorly. Professional tasting and assessment of the cask at regular intervals, typically every 3 to 5 years, is important for managing this risk. The fourth risk is regulatory change. Whiskey is a regulated product. Changes in alcohol regulations, export duties, or the rules governing whiskey production could affect the value of casks. This is a lower probability risk, but one that sophisticated investors monitor. So how does an investor actually get into the whiskey cask market? The most direct route is purchasing a cask directly from a distillery or through a specialist broker. Distilleries, including Springbank, Glenfarclas, and several independent bottlers, offer casks directly to investors. Prices start at approximately £2,000 to £5,000 for a new make cask from a reputable Scottish distillery and can reach into 6 figures for aged casks from prestige producers. The cask is stored in a bonded warehouse. You pay annual storage fees, typically between £50 and £200 per year. And you receive a warehouse receipt as proof of ownership. When you are ready to exit, you have several options. You can sell the cask to another investor through a broker. You can have the cask bottled and sell individual bottles, which typically generates a higher per unit return, but involves more cost and complexity. Or you can sell it to a blending house or independent bottler. The second route is through specialist whiskey investment funds and platforms. Companies like Cask Trade, Whisky Invest Direct, and the Whisky Investment allow investors to buy and sell casks through organized platforms with more transparency and liquidity than the private broker market. These platforms have grown significantly over the past 5 years as institutional interest in the asset class has increased. The third route, and the most accessible for individual investors, is through fine whiskey auction platforms. Platforms like Whisky Auctioneer, Scotch Whisky Auctions, and Katawiki allow investors to buy individual bottles of rare whiskey at auction with relatively low minimums. This is the bottle market rather than the cask market, but it provides exposure to the same underlying appreciation dynamics: scarcity, age, distillery reputation, global demand, with much lower entry costs, 564% over 10 years, outperforming gold, fine wine, and equities. Sitting in a bonded warehouse in the Scottish Highlands, quietly aging, losing volume to evaporation, gaining complexity and value with every passing year. Whiskey casks are one of the most tangible, most tactile, most genuinely interesting alternative assets available to sophisticated investors. And for those who approach this market with proper due diligence and patience, the returns have been extraordinary. Subscribe to Capital Above Convention for weekly deep dives into the assets, structures, and strategies that the world's most sophisticated investors use to build and protect wealth. And I'll see you in the next one.